This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Dan O'Brien, K-State grain economist, kicks off today's show discussing the current grain market. He talks through futures, exports, and price seasonality for corn, grain sorghum, wheat, and soybeans. Keeping today's show rolling is Brian Briggeman, director of the Arthur Capper Cooperative Center at K-State, as he explains the impact that Section 199 AG has had for cooperatives' deductions. K-State meteorologist Chip Redmond ends the show with a weather outlook. He says that Kansas can expect to cool down and if the weather has been seasonable or unseasonable. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show with a grain market update with K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, today talking through the different commodities and touching on futures, exports, and price seasonality as we talk through them. And first, starting off with feed grains.
Yeah, corn and grain sorghum are primary feed grains that we grow here in the state of Kansas. And corn futures, since harvest, have actually come up and shown some strength. In essence, at their low here this fall, they got down to about 4 earlier in the summer. That'd be the Mart now, which is now the lead contract that's being traded off of by elevators, et cetera, what we figure basis off of. That traded down to about 384 back in September, late August. So then went up to about 430, fell back down to 395 thereabouts. Now, after going back and touching that 430 or so, we're trading about 426 and 3/4. At least that's what we were yesterday on the market. So we're in a market that's representing seasonal situation. When you read the analyses, there's a fair amount of what technical traders call resistance at some of these levels, resistance from going higher, support from going lower. So in a way, we're sort of range bound. I would say that when you look at one technical tool, relative strength indices, which I like to follow, it's trading just slightly above 50% in the last several days as an average. So the bottom is not falling out, but we're not racing to the top either. So you got that going on. I would say we're in the mode right now of looking at demand issues. And what's right in front of us for corn would be ethanol demand on the one side, which is looking actually very, very good. Ethanol production setting about 2 weeks ago set a record. Then this last week was near that again. Stocks are actually declining, have been with the latest numbers I've seen. So that's a tremendous situation for ethanol plants and shown some profitability in all of that with lower priced corn. And we have that happening at the same time as we have a decent pace of corn exports. Corn exports had about 38 million bushels worth of exports for the week ending November the 14th. And overall, we're about, with 11 weeks through the market year, about 21% of the way through. We bought ahead to about 53% of that, or about 1.2 billion bushels out of the 2.325 the USDA is projecting. So you stand back and we look at the demand of major crop like corn. And so what would affect the ethanol side? Well, it would be the U.S. economy. Does gasoline demand hold up? And how does that affect ethanol? On the one hand, what would affect the export side? Well, issues internationally, geopolitical risk affecting financial markets, impacts the U.S. standing in the world. We have had strength of late post-election in the U.S. dollar. And so that's kind of a headwind for exports. But overall, on the supply-demand side, we're holding up okay. Not anywhere near the price that most Kansas producers would like to have, which is about at least 50 to 75 cents higher at the local level. To actually cover our costs, all of our costs. Anyway, we are as we are. For grain sorghum exports, we've seen a so-so pace, about 2.4 million bushels for the weekend ending November the 14th. And as far as being bought ahead, again, we're about 11 weeks in and about 21% of the way through, and we only have 18% bought ahead. Grain sorghum seems to be affected in a major way by trade discussions between the United States and China, and the anticipation that if there's one of our ag commodities that would be at risk to take a hit, it would be grain sorghum. And people see that because that's what happened the last time that the U.S. and China had trade tensions like this. So the USDA still projects about 220 million bushels of grain sorghum to be exported, but so far only 40 million has happened, and here we're about 1/5 of the way through the marketing year. So that situation is as it is. Seasonally, I think as you talked about at the beginning of our show, there's the question, where will prices go this year? Well, if nothing happens, if it's a docile year, we don't have major geopolitical risks causing big problems, we would tend to see prices from October to November ease higher from about 96, 97% of the overall season average price that we've seen for this marketing year, and then move into February a little sideways to slightly lower in March, and the real strength to come in May and June, particularly May. So for anybody storing corn unsold, that's probably what we're looking for, and are watching the news closely to see what else in the world might occur in terms of factors that could change the market. So far, that probably, aside from these geopolitical issues on the demand side, they've had rain in South America, a major competitor for corn, and that really, other than just general risk and uncertainty, not really seeing any big threats so far to production out of South America. So there's still quite a ways to go. We'll be watching that closely all the way through December, January, February, and March. But so far, no big problems there. And even with that, we've got a market for corn futures that's basically pretty much hanging in there sideways at about 425 to about 430.
Dan, what are we seeing for wheat? For
wheat, basically, we've seen prices close for hard red winter wheat futures at 555 and a half for the Dees contract, 567 and a quarter on the March contract, up about 5.5 cents. And that price, the wheat market has shown more weakness generally than the feed grain market, than corn futures. Had dropped down here we just in the last week or so to below 550 for the March contract, have come back up to about 567. The highs here in the last 3 months, basically at about 630, 640. So just a kind of a quagmire of a deal, in that dry conditions in the Black Sea regions, threats of all that's happening, riled up worries in the world side of export movement. We had about 3 or 4 weeks of pretty strong wheat exports coming into play, but things have kind of slowed down since then. U.S. hard red winter wheat exports came in week ending the 14th at just a little over 2 million bushels. We need about 4.7 to meet the USDA's projection. So after some excitement, we're back to going sideways. Really, probably the biggest news in the hard red winter wheat market right now is that we had rain, and our prospects have improved quite a bit. Seasonally, from where we're sitting right now, we tend to see wheat prices actually from October to November, really all the way through February, moved just slightly higher. It's really a pretty flat market. In the last 5 years, when we've had anything happen in the wheat market, it's happened mainly out there from April heading into May. And I don't know if people can store wheat that long to wait for that, but that's when we've seen price movement happen.
And wrapping up our commodities for today, talking about soybeans.
Yeah, soybeans closed yesterday, the January contract at 977 3/4, down 12 3/4 cents. Again, that's noteworthy there. It's we're below 10. We're below $10 a bushel. And soybean futures, the January contract, just about like wheat in terms of showing weakness of late. In essence, the lows that we had back in August of of this year, we're back at them. So we're not displaying a lot of strength in terms of soybean futures at this point. In fact, the last 2 or 3 weeks we've been in a tortured path, basically sideways to lower. And I would say now that's happened at a time where, gosh, we've been moving some beans. That's been a good thing for the week ending the November 14th. We moved 90 million bushels of wheat, which is a very good pace. We need about 29 to meet the USDA's projection. And of course, you're dealing with a situation where we have about from now till about into January and February, or early February, to make hay, quote, in terms of U.S. soybean exports. And so this is the time to do it. But after that time, once what's coming out of South America starts to come, this 90 million bushel number falls way off to 5 or 6 or 7, maybe 10 million bushels. So pretty tough. The seasonality for soybeans and the limited time we've got left, basically less for soybeans than for feed grains, more than for wheat. But from October, November, we tend to see price rises into January, but in a little bit more into February. But gosh, if anything's going to happen seasonally, in the last 5 years, it's happened from now into January, and from there, absent major crop problems in South America, we've seen pretty much sideways prices. So the very high was in May, of course, but you were almost there, just within a few percentage points of it by the time we got to February or March. So we tend to jump up into January and then plateau. And with that, it's a coin flip, whether you hold them anymore and it's going to pay off or not. Do we end up with a drought in South America? I'd say in terms of geopolitical issues this go around, China, the dominant soybean buyer in the world, has been, again, with these trade issues all up in the air, been buying aggressively from South America, Brazil, Argentina. And you do have some things happening in soybean oil, soybean meal that had brought in some support at times into the market. So we're here just ahead of Thanksgiving, markets being just kind of so-so, all sorts of things happening overseas that if they affected shipping lanes, if they brought about sanctions, would change the face of these markets in a major way. But they're not happening yet. Until they do, we seem to just be thinking that, well, we're going to wait and see if they actually occur. When they do, we'll react then, but we're not going to worry about it that much at this moment.
Dan, I appreciate you taking the time to join us and give us our grain market update.
Thank you very much, Shelby.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we continue our show talking about the impact that Section 199AG has had on local grain marketing and farm supply cooperatives with Director of the Arthur Capper Cooperative Center at K-State, Brian Briggeman. Brian, thanks for joining us today.
Thanks for having me, Shelby.
Brian, what is the history of Section 199's deduction?
So actually, this deduction goes all the way back to the Bush tax cuts back in 2004. So it was a period of time when the manufacturing industry was struggling, kind of coming off of a recession. There was a lot of questions in the economy. And so the Bush administration put together a tax bill that offered the Section 199 deduction, or the Domestic Production Activities Deduction, or DPAD, to manufacturers. The way that it was structured was it provided an incentive to manufacturers to hire additional workers to come in, and then the company that did that was able to claim that those wages as a deduction, so a portion of those wages. So the idea was you hire more people, you have this tax deduction. Well, throughout, as we kind of got away from 2004, some agricultural marketing cooperatives had the discussion of, farmers are manufacturers, right? We turn seed into commodities that we can use. And the farmer cooperative, the marketing cooperative, is part of that as well. So through a private letter ruling with the IRS, many co-ops were able to claim a DPAD, or Section 199 deduction. So that was happening, and we didn't really see a lot of farmer co-ops at the time take advantage of the deduction because it did require a private letter ruling from the IRS, and we just didn't see as much uptake. But all of that really changed in 2017 with the Tax Cuts and Jobs Act. So at that time, the new Section 199A deduction was introduced. And then in 2018, it was actually codified into law to what we now have today as Section 199AG deduction that farmers can utilize as well, but also farmer cooperatives can use that. So this fact sheet is meant to look at that impact, to look at data to say, how has that impacted the farmer owners of our local grain marketing farm supply cooperatives?
And so how did you find this data, or what's the background and setup to this fact sheet?
Sure. So a colleague of mine, Gerald Mashangi, who's an assistant professor at the University of Illinois, we were actually sitting around at an Ag Econ meeting just talking about this. And both Gerald and I have worked with some financial data of farmer cooperatives, balance sheet, income statement information that is made available through an agreement with CoBank. So CoBank is the primary lender to many farmer cooperatives. But of course, with this confidentiality agreement, I have no way of knowing who is in the data, but I have the data. And so through this discussion and just kind of talking back and forth, we felt that, hey, we could maybe come up with an estimate of what the 199A deduction would be for the farmer cooperatives that are in this data set. And again, when I say farmer co-ops, it's the local grain marketing farm supply co-op. So we, just went into the data and came up with an approach, a method to estimate what that deduction is. Because, again, in the data, it doesn't report the deduction, but enough information that we could likely get really close.
How has that deduction amount changed from 2018 to where we are now?
Well, one thing that we did in this fact sheet was to provide the total, right? So for all of the cooperatives that we have in the data from 2018 to 2023 is 783 different co-ops. Now, some go in and out of the data, but 783 total. And when we look at that sum total starting in 2018, when it was codified in law, that based off our estimates, there was about $745 million available for this deduction. And then that has grown over time to about $845 million in 2023. So I think you see that deduction, but the thing that's great about that deduction is that it doesn't just stay at the cooperative. It's actually being utilized in a way, at least from comments that we hear from cooperative leaders, CEOs, CFOs, about how they utilize the deduction to the benefit of their farmer owners.
What have you seen or heard about for some of that utilization for those farmer owners?
So a lot of these co-op leaders have pointed to the ability of the cooperative to use the deduction to help support additional higher cash patronage payments to their farmer owners, as well as to retire equity that these farmer owners have within the cooperative, the retained patronage that will be retired at a later date. This deduction allows them in order to be able to redeem those equities in larger amounts. We also have heard a number of stories and anecdotes that co-ops are able to utilize the deduction to build or add to property, plant, and equipment. So upgrades, additions, those capital expenditures.
If we take the time to also look in this fact sheet at Figure 2, which is the average of available Section 199 AG deduction, allocated equity redeemed, cash patronage paid, and change in local non-concurrent assets for farmer cooperatives, the trends look to be pretty significant.
You are right, Shelby, that it is pretty striking to look at how from 2018 to 2023 for the average farmer cooperative in this data that there's quite a bit more Section 199 AG deduction available to them. So as we look, we can see it moving up to nearly $2.5 million on average, a deduction available to these farmer cooperatives. But also it's important to kind of see maybe some of the potential linkages with those other things that cooperative leaders have told us on how they use the deduction to the benefit of their farmer owners. And in the figure, you definitely see some correlation. Now, of course, that doesn't necessarily mean causation, but there are some trends that as we see more 199 AG deduction available to a cooperative on average, we see larger amounts of, money going out to the countryside. In fact, in 2023, the average deduction available of $2.5 million for the farmer cooperative about equaled the average amount of funds or money that was going out in the total of cash patronage and equity that is being redeemed. So looking at, this amount of average of the deduction, tied to that money going out is pretty significant. So it's certainly a sizable deduction. And then also, too, the co-op has the ability to pass some of this deduction through back to their farmer owners. And what's unique about that is because many farmers do not have the W-2 wages that a cooperative would have. So the Section 199 AG does have some of that connection back to those Bush tax cuts, the Section 199 that started back in 2004. And the key is those wages. So the co-op, because they have employees and pay W-2 wages, they can also pass some of that deduction through to their farmer owners, which helps lower the farmers' taxes.
And why this year is maybe looking at the impact that Section 199 AG has is really important.
Yeah, so the reason, for putting this fact sheet together is because this tax benefit is set to expire in 2025. So the put this fact sheet together really intended for policymakers and their staff to just take a look at what some of these financial trends appear to be. Because as we have this debate and discussion around the future of Section 199 AG, we just need to, consider these financial implications, right? What does it mean? Where it lands, does it expire? Is it extended? Is it made permanent? Well, that's not for me as the economist here, but to rather show some data to, add to the discussion. One thing I should also note with the fact sheet that I'm not able to show is the amount of that deduction that is actually passed through to farmer owners. But that's certainly, talking to many co-op leaders, that does happen. So that is another way for farmers to pay less tax.
Brian, so maybe farmers, ranchers using this fact sheet as a resource if they ever get the opportunity to talk to a representative?
Yeah, I think it's something to, draw a point to and just use it as a reference, right? As some information, then looking at data can help add to the discussion around the future of Section 199 AG.
Where can people find this fact sheet?
So we make it available on our website through the Arthur Capper Cooperative Center at K-State. And our website address is www.accc.ksu.edu.
Brian, I appreciate you taking the time to join us today.
Thanks a lot, Shelby.
That was Director of the Arthur Capper Cooperative Center at K-State, Brian Briggeman. You can read this fact sheet publication titled Impact of Section 199 AG on local grain marketing and farm supply cooperatives by following the link in today's show notes on agtoday.net, or you can also find it for yourself by going to the Arthur Capper Cooperative Center's website, which is www.accc.ksu.edu, or you can also find it by going to AgManager.info. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned in to Agriculture Today, and we conclude our Friday show with a weather update with K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, thanks for having me.
Chip, what have we seen this past week in terms of precipitation?
Another week, another round of significant moisture across the state and the region, with another impactful system Sunday through Tuesday that brought rain and thunderstorms, some wind too. We had some high wind roll through central and eastern Kansas, and man, I really wish you could have got some of this rain in the summer months. It would have been nice. It was a nice, pretty moderate to light rain at times. We ended up with over 2 inches again in southwest Kansas, and then pretty much widespread 3/4 of an inch to an inch. The only exception, and there was an exception this week, was northwest Kansas, where they missed out on it, but they've gotten in on the other systems before this. So much above normal precipitation. Again, we only average around 1/10 of an inch to about 4/10 of an inch as you get more in the southeast. So when we see rainfall totals double, triple, even sometimes 10 times or 20 times as much, that's just a lot of rainfall. And we've been really lucky it's fallen as light as it has. It's reduced erosion impacts and that kind of thing. Winter wheat looks really good. It keeps getting help. We keep getting these sunny, dry periods in between these storms. So things are good. We've stored in more moisture in the profile, and hopefully we can keep that as we go into the spring.
Should producers maybe be seeing their ponds filling up some?
Yeah, the hope is by this point, looking at over the last 30 days, some places have gotten 8, 10 inches of rain. And they only average around an inch in southeast Kansas. And so to get 6 or 7 inches of rain is impressive. Obviously, they average more rain in southeast Kansas where they got 10 inches. But again, they needed it. It was really bad. So that moisture is kept soaking in the ground. We're to the point now where the profile is pretty saturated. So any rainfall we're starting to receive, whether it's light or moderate, the ground's pretty much reaching its capacity. So we're starting to see increased runoff. Stream flows have really picked up over the last week statewide, and now we're starting to refill those ponds. Unfortunately, we still have a long ways to go in some places, especially north central Kansas, where we still have moderate drought in place, but we're definitely a step in the right direction for refilling those ponds.
What about for temps? How have they been looking compared to the average or normal?
Yeah, so temperatures have been unseasonable. They've been above normal, and with as much moisture as we have in the air, it's really hard to drop those temperatures. But we still have had that jet stream pattern to our north over Kansas, over Nebraska, and we keep getting this Gulf moisture moving northward as a result. And as long as we keep that, we keep above normal temperatures because we just can't tap into the true cold air. However, we have had a transition in the pattern here at the end of the week where we did get some cooler weather finally in, a little bit more northwest flow, more seasonable temperatures as that jet stream has slightly shifted south and we've lost that Gulf moisture. And as we move forward, it looks like we're going to get a quick buckle back up in the jet stream with strong southerly winds over the weekend. Temperatures are once again going to become unseasonable and warmer than normal through the weekend. But then we go right back down and we're starting to see more dips than ridges at this point, and we're seeing more cool air starting to win out overall as we get further and further into winter. We're doing that seasonal transition of getting more cooler air in here, and our average temperatures are still falling. We should see temperatures around 50 for highs and for lows in the mid to upper 20s. And so that would be average. And it looks like even through next week, we're going to be a little bit below that, I think, potentially, and potentially carry that even into December.
Chip, what's a quick forecast we have for Kansas?
Yeah, so the temperatures will be cooler than normal. The big question is precipitation. At this point, northwest flows colder air. It's drier air, but there are hints that we could potentially be entering a storm track that's more favorable for winter precipitation as you get into the Thanksgiving Day time period. Right now, a lot of the Northeast is seeing their first taste of winter, and a lot of the West is seeing it. And it's just a matter of time until I think central Kansas does get a taste. And there's potential come late next week that we could have a winter storm somewhere in the U.S., probably in the central U.S., dropping some snow.
Chip, I appreciate you taking the time to join us today and give us our weather update.
Yep. Thanks for having me.
That was K-State meteorologist Chip Redmond. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.